Here's a question almost nobody can answer correctly. How much money do you actually need to retire? Not a guess, not $1 million because that sounds like a big safe number, not $2 million because you saw a headline that scared you. The real, calculated answer. The number that is specifically yours based on your life, your spending, your timeline, and your risk tolerance. Today, I'm going to give you the exact formula that financial planners and early retirees actually use. A formula built on decades of real market research, not wishful thinking, not motivational fluff, not some guru selling you a course. Real, peer-reviewed, historically stress-tested mathematics. And by the end of this video, you'll be able to calculate your own personal retirement number in about 30 seconds. But before we get to the formula, we need to talk about why almost everyone gets this wrong. And the reason is simpler than you think. Let's start with the myth. Most people think retirement planning means picking a random big number. 500,000, $1 million, $2 million, $3 million. They pick a number that sounds impressive, that sounds safe, that sounds like something a responsible adult would say at a dinner party, and then they just hope it's enough. They hope the market cooperates. They hope inflation doesn't eat them alive. They hope they don't get sick. They hope, hope, hope. But hope is not a financial plan. And real retirement math doesn't start with a lump sum. It doesn't start with a number you pull out of thin air. It starts with a percentage. And that percentage is called the safe withdrawal rate. Here's the idea in plain terms. If you have a portfolio of invested money, stocks, index funds, bonds, retirement accounts, the safe withdrawal rate tells you what percentage of that portfolio you can spend every single year without running out of money. And I mean without running out of money, even accounting for market crashes, recessions, pandemics, wars, and decades of completely unpredictable returns. It's the percentage that says no matter what the economy does for the next 30, 40, or 50 years, you will not go broke. The most famous number in this research is 4%, and it doesn't come from some random blog post or a YouTube video. It comes from a landmark piece of research published in 1994 by a financial planner named Bill Bengen, and later expanded and confirmed by what's known as the Trinity Study, conducted by 3 professors at Trinity University in 1998. These researchers didn't just guess. They took historical market data going all the way back to the 1920s. They simulated thousands of retirement scenarios. They tested what would happen if a retiree withdrew money every single year through every major crash in modern market history, the Great Depression, where the stock market lost nearly 90% of its value, the 1970s stagflation era, where inflation ran wild and stocks went nowhere for a decade, the dot-com bubble burst in 2000, the 2008 financial crisis, where the entire global banking system nearly collapsed, every single disaster, every single worst-case scenario, and they ran the numbers on all of them. The finding was remarkable. If a retiree withdrew 4% of their portfolio in year 1 and then adjusted that dollar amount for inflation every year after, their money lasted through a 30-year retirement in the overwhelming majority of historical scenarios tested. Not all of them, but the vast, vast majority. Even the bad ones, even the ones where you retired the day before the worst crash in history. That's where the 4% rule comes from. It's not a guess, it's not a marketing number, it's the output of real historical stress testing across nearly a century of market data. It is, quite literally, the most battle-tested retirement formula in existence. Now here's where it gets genuinely useful, and this is the part that changes everything. If 4% is the amount you can safely withdraw each year, you can flip the formula around, you can reverse engineer it, and when you do, you can calculate exactly how much money you need in total. The math is almost embarrassingly simple. Take your desired annual spending in retirement and multiply it by 25. That's it. That's your number. That's your financial independence number. Why 25? Because 4% is 1/25th. If you can safely pull out 1/25th of your portfolio every year, then you need 25 times your annual spending sitting in that portfolio. The math is circular, but the application is incredibly powerful. Let's make this real with some actual numbers. Say you sit down, you look at your budget, and you calculate that you need $50,000 a year to live the lifestyle you want in retirement. Not a lavish lifestyle, not a poverty lifestyle. Just your life, your rent or mortgage, your food, your transportation, your healthcare, your entertainment, your peace of mind. $50,000 a year. 50,000 multiplied by 25 equals $1,250,000. That is your number. That is the amount of invested assets that would allow you to safely withdraw $50,000 a year, adjusted for inflation, indefinitely, based on decades of historical market stress testing. You could wake up tomorrow with that number in a diversified portfolio, and the math says you never have to work again. Now let's do another one. Say you live in a lower cost of living area, you don't have kids in the house anymore, and you calculate that you only need $36,000 a year. 36,000 times 25 equals $900,000. Your number is 900,000. Not a million, not 2 million, 900,000. And on the other end, say you live in a high-cost city, you have a family, you want to travel twice a year, and your number is $80,000 annually. 80,000 times 25 equals $2 million. Notice what just happened here. We didn't guess a number. We didn't pull a figure out of a magazine article. We reverse engineered it from your actual life. Someone who needs $40,000 a year has a completely different number than someone who needs $80,000 a year. And that's exactly why generic advice like you need $1 million to retire is almost meaningless without knowing your own spending number first. $1 million might be way too much for one person and dangerously not enough for another. Let's talk about why this formula actually works, because understanding the mechanism matters more than memorizing the number. If you understand why it works, you'll trust it, and if you trust it, you'll stick with it. And sticking with it is where 90% of people fail. When your money is invested, say in a diversified, low-cost stock index fund that tracks the entire market, historical average returns have been around 7% annually after adjusting for inflation. This is based on long-term S&P 500 performance data spanning nearly a century. 7% after inflation. That means your purchasing power is growing by 7% a year on average over long time horizons. Now, if you're only withdrawing 4% a year, do the math. 7% growth minus 4% withdrawal equals 3% net growth. Your portfolio has historically continued growing even while you're taking money out, especially in the early years of retirement. That growth is what allows the math to survive market crashes, because in good years, your portfolio grows faster than you're withdrawing, building a buffer, a cushion, a safety net for the bad years. And the bad years will come, they always do. But the good years more than compensate as long as you don't panic and sell everything at the bottom. Now, let's talk about the part almost nobody mentions, and this is critical. This isn't a perfect universal guarantee. No financial formula is. The original research was based on a 30-year retirement window. 30 years. That's retiring at 65 and needing the money to last until 95. That's a long time, but it's a defined window. If you're planning to retire in your 30s or 40s instead of your 60s, your money needs to last 40, 50, even 60 years. In some updated research, including more recent studies that incorporate lower expected future returns and longer lifespans, suggests a slightly more conservative withdrawal rate, closer to 3.5%, may be safer for extremely long retirement horizons. 3.5% instead of 4%. That changes your multiplier from 25 to roughly 28 or 29. This is exactly why the early retirement community often talks about a range, not a single fixed number. Anywhere from 3.5% to 4%, depending on how early you're retiring, how much flexibility you have to adjust spending during down markets, and how conservative you want to be. If you're retiring at 35, lean towards 3.5. If you're retiring at 60, 4% is well supported by the data. Now let's talk about sequence of returns risk, because this is the single biggest danger to this entire strategy, and almost nobody explains it clearly. This is the thing that can break an otherwise perfect plan. It's not about your average return over 30 years, it's about the order those returns happen in. Think about it this way. Imagine two retirees. Both start with $1 million, both withdraw $40,000 a year, both experience the exact same set of market returns over 30 years, the same crashes, the same booms, the same average. The only difference is the order. Retiree A experiences a massive market crash in years 1, 2, and 3. Their portfolio drops by 40% right out of the gate. They're still withdrawing $40,000 a year, but now they're withdrawing from a much smaller portfolio. They're selling stocks at the bottom. They're locking in losses. And because their portfolio is so much smaller, the recovery in years 4, 5, and 6 doesn't bring them back to where they started. They never fully recover. They run out of money in year 28. Retiree B experiences the exact same crash, but it happens in years 25, 26, and 27. By that point, they've had 2 decades of growth. Their portfolio is much larger. The crash hurts, but they have so much buffer built up that they survive easily. They never run out of money. Same returns, same average, completely different outcomes. The only variable was timing. That's sequence of returns risk, and it's why the first 5 to 10 years of retirement are the most vulnerable. This is why many early retirees keep 1 to 2 years of living expenses in cash or in safer liquid holdings like short-term treasury bonds or high-yield savings accounts. Not because it grows much, not because it beats inflation, but so they're never forced to sell stocks at a loss during a downturn just to cover living expenses. They can live off the cash buffer, let the market recover, and then refill the buffer when stocks are back up. It's a simple strategy, but it dramatically reduces the risk of ruining your plan in the early years. Now let's build out a real detailed scenario so you can see how this plays out over a lifetime. Imagine someone who determines they need $48,000 a year to live comfortably. They've tracked their spending, they know their numbers. Using the 25 times multiplier, their financial independence number is $1,200,000. They're currently 30 years old. They have a decent job, not a spectacular one, but they earn enough to invest $2,000 a month into low-cost, broadly diversified index funds. They automate it. Every single month, $2,000 leaves their checking account and goes into their investment account. They don't think about it, they don't time the market, they don't panic when the news says the sky is falling. They just keep investing. Assuming a historical average annual return of 7% after inflation, that consistent monthly investment would realistically grow to that $1,200,000 target somewhere in their early 50s. 20 to 22 years of consistent investing. No lottery tickets, no risky business ventures, no trying to pick the next hot stock. Just time, consistency, and compound interest doing the heavy lifting. And here's the beautiful part. Once you know your actual number, financial independence stops being a vague, overwhelming, anxiety-inducing dream and becomes a specific, trackable target. You can literally watch your progress every single month. You can open your brokerage account and say, I'm at $480,000. My number is $1,200,000. I'm 40% of the way there. That shift from someday I'll have enough to I need $1,200,000 and I'm 40% of the way there is one of the most motivating moments in anyone's financial life, because ambiguity is what makes people give up. Ambiguity is what makes people say, I'll never get there, so why bother? Clarity is what makes people stay consistent. Clarity is what makes you automate that $2,000 investment every single month for 20 years, because you can see the finish line, you can measure the distance, you can watch it shrink. Let's talk about common mistakes people make with this formula, because the formula is only as good as the inputs you feed it, and most people feed it garbage. Mistake 1. Forgetting to include healthcare costs. This is massive, especially for anyone retiring before 65, before Medicare kicks in. If you retire at 45, you need to fund 20 years of private health insurance. Depending on your state and your situation, that could be $500 to $1,000 a month for a marketplace plan, or more if you use Cobra. That's $6,000 to $12,000 a year that you need to add to your spending number before you multiply by 25. Many people calculate their number based on their current employer-subsidized healthcare and then get blindsided by the real cost when they actually leave their job. Mistake 2. Assuming your spending will stay exactly the same for 30-plus years. It won't. In reality, expenses shift significantly between early retirement, mid-retirement, and later years. In early retirement, you might travel more, spend more on experiences, maybe still have a mortgage. In mid-retirement, spending often drops. Kids are gone, the house is paid off, you're more settled. In later retirement, healthcare costs tend to rise again. Some researchers call this the retirement spending smile. Spending is higher at the beginning, dips in the middle, and rises again at the end. Your plan should account for that curve, not assume a flat line. Mistake 3. Ignoring taxes on withdrawals. This is a big one. Money coming out of a traditional 401k or traditional IRA is taxed as ordinary income, so if you need $50,000 a year in your pocket, you might actually need to withdraw $58,000 or $60,000 to cover the tax bill. That changes your number. On the other hand, money coming out of a Roth IRA or Roth 401k is completely tax-free in retirement. Capital gains on taxable brokerage accounts held for more than a year are taxed at lower rates. The tax efficiency of your withdrawal strategy can add or subtract hundreds of thousands of dollars from your effective retirement number over a multi-decade retirement. And mistake 4, treating 4% is a rigid, unbreakable rule instead of a flexible guideline. The original research assumed a fixed, inflation-adjusted withdrawal every single year, no matter what the market did. But in real life, many successful early retirees adjust their spending slightly during market downturns. If the market drops 30%, maybe you skip the vacation that year. Maybe you eat out less. Maybe you delay the home renovation. That small, temporary reduction in spending dramatically increases the safety of the entire plan. Flexibility is the ultimate risk management tool. You don't have to live on a fixed number forever. You just have to be willing to bend a little when the math asks you to. So here's the framework to take with you. These are the 5 rules I want you to write down, screenshot, or tattoo on your brain. Rule 1. Calculate your real number using your actual desired annual spending multiplied by 25. Not a generic round number you saw online, not what your neighbor thinks you need. Your number, based on your life. Track your spending for 3 months, annualize it, add in healthcare and taxes, and multiply by 25. That's your target. Rule 2, if you're retiring especially early, lean toward the more conservative end of the withdrawal rate range. Use 3.5% instead of 4. Multiply by 28 or 29 instead of 25. Protect against the longer retirement horizon. The extra cushion costs you a little more in savings today, but it buys you decades of security tomorrow. Rule 3, keep a cash buffer, 1 to 2 years of expenses in liquid safe holdings. This is your armor against sequence of returns risk. This is what lets you sleep at night when the market drops 20%, because you know you don't have to sell a single share. You can just live off the buffer and wait. Rule 4, build in flexibility. Your spending, and therefore your withdrawal rate, doesn't have to be fixed forever. Give yourself permission to adjust. The plan is a guideline, not a prison. The people who succeed at early retirement aren't the ones who rigidly stick to a number. They're the ones who adapt. And Rule 5, track your progress toward your specific number consistently. Check it monthly. Celebrate the milestones. 10% of the way there, 25%, 50%. Because clarity is what keeps people investing when motivation runs low, and motivation will run low. There will be months where the market drops, where you feel like you're not making progress, where the whole thing feels pointless. In those moments, looking at your number and seeing that you're closer than you were last year is what keeps you going. This is the actual math behind financial independence, not a fantasy number, not a guess, not a guru's promise. A formula built on nearly a century of real market data, tested through every crash, every recession, every period of economic chaos the modern world has thrown at it. It won't make you rich overnight. It's not designed to. It's not a get-rich-quick scheme. It's a get-free, eventually system. And it's designed to tell you, with real, mathematical confidence, exactly when you're actually free. So here's my question for you, and I genuinely want to know. Comment below and tell me, have you ever actually calculated your real retirement number? Have you sat down, tracked your spending, done the multiplication, and looked at the result? Or have you just been guessing like most people do? Have you been saying, I'll figure it out later, while the years quietly pass? Let me know in the comments. I read every single one. And if this video gave you clarity, if it turned a vague anxiety into a concrete plan, then subscribe to the Violet Vault. Hit the notification bell, because next time we're breaking down another strategy that turns financial confusion into a clear, actionable plan. We don't do fluff here. We do math, we do strategy. We do the things that actually move the needle. Because remember, retirement was never about hitting some random big number. It was never about $1 million or $2 million or whatever number makes you feel safe at a dinner party. It was always about knowing your number, your specific, calculated, personal number, and then building toward it on purpose every single month until one day you wake up and realize you're free. Thanks for watching the Violet Vault. I'll see you in the next one.